So today we're going to talk about, one of the bigger conversations with product teams in Australia, in the Australian market today, which is around, okay, how to build a product with lower income replacement ratios.
Yeah.
Can you talk to us a bit more about the issues with that?
Well, I think everyone's known for a while that high income replacement ratios provide an issue around sustainability and insurability. And APRA's called that out in their feedback to the industry. So it's an issue that companies are thinking about, but they have problems around, well, how do I price for a lower income replacement ratio?
So what do you think the approach will be that most life insurers will take?
So historically, what companies have done is they've simply said at a lower income replacement ratio, that's a lower amount of benefit, and they just proportionally reduce the premium to reflect that lower amount of benefit. That tends to lead to a relatively small price differential, which certainly hasn't been enough for advisors to recommend selling a lower income replacement ratio. It's always been available, but very little has been sold, which just tells you that the price differential isn't sufficient to drive demand.
So within Montoux, you and I and the various teams here have had various discussions and have done some research around, okay, so what's happened in other countries? Are there any studies that we can draw from just to get some better understanding about how income replacement ratios actually affect claims? And by looking at differences in countries, that have higher and lower income replacement ratios, and looking at studies out there that look at different income replacement ratios within the same environment, we do see that there can be a very significant impact.
Yeah.
So could you also talk to us a little bit more about the potential risks or issues that could occur if you just do the proportional pricing rather than the proper repricing of the risk?
Yeah, so I think if you look at those studies that you've referred to there, they look at the difference not only in the amount of the benefit, but also in how the incidence of claims and also how long those claims last. And those studies would show that those effects are, if anything, bigger than the actual reduction in the benefit itself. So whereas you might reduce the benefit amount by 20%, the cost of claims could be as much as, say, 50% lower. So a company that understands that and takes that into account in their pricing is going to have a much larger price differential and a more reflective price differential than a company that doesn't do that work, and is likely therefore to obviously sell more business. And the danger for the company that hasn't done the work and therefore doesn't have the appropriate price differential is that they don't sell any of the new low income replacement ratio product that they were hoping to sell, and they continue to only sell at that higher income replacement ratio, which has all the risks that we know about in terms of sustainability and insurability that we're trying to address. So I think that there's a real danger that companies spend a lot of time developing a new product, really working hard in the product team to come up with how they want the income replacement, income replacement ratio to look, and how they want their income protection policies to look going forwards. And then because they don't get the price differential right, and because the assumptions haven't been set in a way that allows them to believe that they can get that price down, you don't sell anything, and the whole effort's been wasted.
That's very insightful. Thanks very much for today, Matt. See you next time.